Here's what's coming up on Strategic Wealth with Matt Dickin.
But then if they keep flipping, page 13 has another fee, then 18 has another one, then they keep flipping. I mean, they disclose it in a way that's kind of unfair.
Now, investors will often see this trend and think the bear market's over. Then the behavior kicks in where they don't want to miss out on the gains, and then they buy back in right before things to head back down again.
You know, a lot of times we'll recommend to individuals that they find out exactly what the fees and expenses are that they're paying in their portfolios, especially if they have money maybe in an IRA, 401k, different mutual funds, maybe annuities, things like that. So we developed a strategic wealth report. And Dustin, why don't you talk a little bit about what is required for somebody to provide to us so we can run one of these reports for them, and let's definitely touch on why they would want to get it.
So all that we need in order to produce that report would be a copy of their most recent statement. Now, what it is they could look through that big prospectus that they get in the mail, you know, the one that fills up their mailbox. But what happens is 90% of the time we find that nobody reads that, except for accountants or engineers.
Yeah, we got some, attorneys maybe as well.
Right.
So,
yeah, so I mean, really it takes a certain type of personality to read through that and to find those fees. What they do is they disclose them in a way to where you'll see that 1% fee that everybody talks about is on page 2, real easy to find. But then if they keep flipping, page 13 has another fee, then 18 has another one, then they keep flipping. I mean, they disclose it in a way that's kind of unfair. So that's why you developed that report that we provide on a daily basis.
Yeah, you know, Jordan, I know that you've run a lot of reports for individuals in the community. Is there like a common denominator? I mean, is there a typical fee structure that you're seeing individuals pay when we run these reports?
Yeah, I would say probably 2 to 3%. That's typically what we see. Sometimes it's less. Sometimes I've seen more. I was meeting with a gentleman the other day, and he was actually paying 2.5% in fees. It was about $15,000 a year, which was huge.
Did he have any idea before he ran the report? Did he? Because I think most people realize they're paying something, but do they usually know when it's going to be that high?
He told me he was paying about 0.5%.
He thought it was 0.5%.
He thought it was 0.5%.
Okay, so it was 2.5. So he thought he was maybe paying what, a few $1,000s then?
Yeah.
And he was paying $15,000, right? So that's $150,000 over the course of a 10-year period. So this is why we usually recommend anybody that has money invested in anything other than maybe a CD or money market. You know, anything other than that, it's going to typically have some sort of ongoing fee structure. So we recommend individuals get this particular report. You were mentioning that if you want to, you can find your fees by maybe searching through your prospectus.
Right.
You know, they don't make it easy. And then you got to look at the prospectus on every single mutual fund. You know, at this point, we've run thousands of these strategic wealth reports for individuals throughout the community. And obviously, we have software in the office, so we can put them together pretty fast. We can find out what the fees and expenses are. And I think what a lot of times people find valuable, kind of to your point, Jordan, with the gentleman you're talking about, we'll take a look at all of their accounts. We give them a one-page report, typically, that'll show exactly what they're paying as a percentage on all their accounts, and more importantly, what it is as far as a dollar amount as well. Now, why is it that you think that individuals have to come to a firm like ours in order to get a straight answer on what the fees are that they're paying? Why don't their advisors just tell them how much they're paying?
Well, I would say that sometimes their advisor probably doesn't even know what they're paying. I mean, these are just the mutual fund fees in particular. So people will be, you know, thinking they're paying 1% like we were saying a while ago, but that could be just their advisor fee.
Right.
Inside of each mutual fund that they have their own unique set of fees, and that advisor they're working with or broker that they're working with probably doesn't want to share those with them because it's not going to make him look the best.
Yeah, and I really think knowing and understanding your fee structure is obviously the first step in order to try and get it reduced. Now, sometimes there's nothing that you can do to reduce it, but I think the majority of the time, these high fees, when we find somebody paying 2 or 3, sometimes 4% or more per year, not a one-time fee, but an annual fee. A lot of times when we identify that, there are things obviously that can be done. You can tweak the investments a little bit. Sometimes it's a matter of just knowing what you're paying and calling the firm and saying, hey, I don't really think this is fair. I'm going to go somewhere else if you don't reduce this for me. So there really is a whole lot of value in someone getting this type of report. When you go over the report with Jordan, once we've taken a look at their statements, ran the report, do they usually catch on pretty quickly? I mean, are we talking about something that you have to really be a sophisticated investor to understand?
No, it's really simple to read. We have it broken down so it's easy to read. It's really interesting though. People will first be in denial when they see it. They don't believe the fees are real. And then we go through each position and they see and they start to realize, wow, I'm paying this in fees. I had no idea.
And a lot of times what it does, it allows us to see there's always three types of positions within somebody's portfolio. Some that we like and the fees look okay. Others could be improved, but really what we're looking for, are there any red flags? Is there anything jumping off the page as to this is way too much? And if that's the case, that's what we really help clients to understand and focus on trying to improve.
Yeah, and like you said, sometimes there's not very many red flags, and then sometimes a portfolio is full of red flags. I think when we start getting into an environment where individuals are paying 3.5% or 4% per year, those are red flag scenarios.
Yeah.
And unfortunately, in a lot of cases, sometimes your most expensive positions are also your worst performing.
Right.
Because the fees are kind of acting like an anchor and holding you down. So like we mentioned earlier, if you have money invested in a mutual fund or any type of investment account, you're not sure what your fees are, you're maybe kind of getting the runaround when you talk to your advisors or maybe your brokerage firm when you ask them, and you just don't feel like you're getting a straight answer. Or you're not really sure that you're getting the complete picture, not just what you're paying the advisor, but what the total cost is on the portfolio. Then give us a call. What we're going to do is for the first 10 callers, we'll run one of these reports for you complimentary. Won't charge anything for you, and then you can meet with one of us in the office to go over it with you. Having no clear retirement plan is a mistake I see a lot in my financial planning office when I meet with someone new. It is extremely rare that someone comes in and has a clearly defined income plan for his or her retirement. One way you will be able to get a clearly defined retirement income plan is to talk to an independent financial advisor who specializes in retirement planning. Not someone who has specialized in getting you to retirement, but someone who is dedicated to getting you through retirement. If you don't have a clear retirement plan, then be one of the first 5 callers and you will receive a free complete planning review. There is no cost or obligation as long as you have at least $200,000 saved for retirement. Here's what you'll receive: a free report to sort through your current advisor's costs, a tailored plan to guard your investments, tax analysis to reduce liability and increase cash flow, and a custom income plan to boost retirement. So call now for your free, no-obligation financial review.
When you have confidence in your retirement future, you can live the life you've always imagined. Because of planning, you now have time to reflect on the wonderful memories of your life. You and your spouse finally have the luxury of leisure time together. To spend fun times with your grandkids, sharing the joy of their excitement about life. Smiling at the thought of quality time with your children and of picking up the check. At last, you have time to breathe and rekindle the love of your life. Why? Because you imagined what could be. You planned for retirement. So today, you own your future. Imagine what's next. Plan today, own tomorrow. Call Strategic Wealth Designers, 502-653-6080.
I want to talk about the different types of retirement accounts that are available for you. You've got really 2 different ways of growing a retirement account. You can grow it on a tax-deferred basis, or you can grow it on a tax-free basis. So the real main types of accounts are going to be anything with an employer currently or with a past employer. This could be a TSP if you work for a government. This could be a 401k or a 403b. So any account that you're putting money into on a pre-tax basis, so you're deducting this from your earned income, that's going to be considered a tax-deferred account. The other option is going to be any type of tax-free account. So this is anything you're putting money into on an after-tax basis. It could be a Roth 401k, a Roth 403b, or a Roth IRA. And I want to compare the differences and how you pay taxes on each of them. So it doesn't matter where you invest your money, it's going to be either taxing the seed or taxing the harvest. And I'll show you what I mean by that. When we make money on a 401k or a 403b, we're not paying any taxes on it. So I'm going to put a check in here, okay? Because we're not paying any taxes there. But on a Roth IRA or a Roth 401k, you're going to pay taxes. So when you make the money, when you invest it into the account, you've paid taxes on it. So you're paying taxes here. I'm going to put an X. Now, when it comes to growing your money in a 401k or 403b, you're not paying any taxes along the way. So each year, when you've made some growth, hopefully, in the account, there's not going to be any taxes due on that. So we're going to put a check here. So as the account is growing, no taxes are due along the way. Same with the Roth. So as you're growing along the way, there's not going to be any taxes due. So they're even as far as that goes. Now, let's talk about when you go to start taking the money out. So now you're either retired or you're past 59 and a half and you're wanting to start withdrawing the money. Well, when it comes to a 401k or 403b or IRA, well, now taxes are going to be due. So you're taking the money out, and now it's considered income, so you're going to pay income taxes on it. So whatever tax bracket you're in is what you're going to pay there. When it comes to a Roth account, well, you've already paid the taxes. This is a tax-free withdrawal. So there's not going to be any taxes due when you go to start taking the money out. So we get a check there. Now, the next thing we're going to look at is required minimum distributions. So at 70 and a half years old, the government says, okay, we want our part. So what they do is they make you start taking withdrawals out of your account. Whether you need it or not, they want you to start pulling that money out so that they get their taxes that they haven't been paid yet. So on a 401k or 403b, you may have put that money in there when you were working and only 40 years old or 45 years old. The government hasn't been paid yet. Well, at 70 and a half, they make you start taking the RMDs. So we're going to put an X here because you have to start taking that out. Now on a Roth, because they've already been paid at the beginning, they don't require you to take required minimum distributions. So you can just let that money just sit there and even pass it along to heirs and beneficiaries, and you don't have to take that money out. So it's sitting in there tax-free, and they don't force you to withdraw. When it comes to Social Security, now on a 401k or a 403b, because when you pull that money out and you have to pay taxes on it, it's considered taxable income. So that's going to be a red X. So it is going to potentially affect your income. So, you know, at 62 especially, if you're taking Social Security, you have income limitations on how much you can make before your Social Security is taxed. So you got to be careful to make sure you stay under that rate, and your withdrawals from a qualified retirement plan, which would be a 401k or IRA, is going to be considered taxable income. With a Roth, since it's tax-free when you're taking the money out, there's not going to be any penalty. It's not going to count against your Social Security income. So we're going to put a green check here. So what I'm doing with this is you can see there's pluses and minuses to each of the different retirement accounts. It's important to understand what tax bracket you're in now versus what tax bracket are you going to be in once you retire. If you think that it's going to be much lower than where you are now, it may make sense to go ahead and wait until you retire to start pulling it out. However, if there's not going to be a change in the bracket once you go into retirement, it may make sense to go ahead and pay the taxes now and convert it to a Roth IRA. If you have any questions about Roth IRAs and whether or not they're suitable for you, please feel free to call our office and/or visit our website.
Thanks again for tuning in to today's show. I have to tell you, Dustin and I have been receiving more calls than normal lately from folks like you because people are concerned with what's happening lately in the stock market. They've simply heard from their stockbrokers to stay the course, don't be concerned, but we're definitely seeing a reason to get a second opinion. Now, a lot of that it comes down to having a plan.
Yeah, unfortunately, we've seen a majority of cases lately that people have done a great job saving for retirement, but they and their advisor don't really have a plan as to how to structure their portfolio in retirement.
Yeah, and this is especially the case when it comes down to structuring their portfolio for income. Studies today show that if you remain in the typical balanced portfolio, the appropriate withdrawal rate is 2.7%. So if you had $1 million, that's only $27,000 per year that you should be drawing in retirement. That just seems crazy.
Yeah. When we're structuring a portfolio during retirement, you're looking at closer to 5 or 6% withdrawals throughout retirement. That's why we encourage you to give us a call for a complete retirement review.
Yeah, we can take a look at your current portfolio structure and let you know what kind of yield you're accruing, let you know what kind of risk you're taking, and much, much more.
We'll spend some time talking to you about how to appropriately structure a portfolio during your retirement to generate an income where you don't have to lose sleep when the market isn't cooperating.
We also can't stress tax planning enough. A majority of people who have saved for retirement have their assets in retirement plans such as IRAs, 401ks, and etc. And guess what? During retirement, these are your most highly taxed assets. So we feel that it is our responsibility for our clients to find the best strategies to withdraw those funds at the lowest possible rate, or when the right opportunity rises, to shift those funds over to a tax-free asset. So again, we welcome you to give us a call for a free, no-obligation visit for your complete retirement review. We look forward to sitting down with you soon. Probably around 11 years old or maybe 12 years old, I went to my parents one day and I was kind of confused. I had two different friends whose fathers pretty much had the same job. And when I went to my one friend's house, they never seemed to have any stress when it came to their finances. Pretty much money was never an issue. When I would spend time at my other friend's house, however, it seemed like money was always an issue. If an emergency came up, they wouldn't necessarily have the money to pay for those emergencies when they came up. And I was really confused by this, so I said, what's going on? And my parents told me, they said, well, Matthew, probably what's happening is the one family kind of budgets and plans and saves, whereas the other family doesn't really follow a budget and they're kind of spending everything that they have. And I said, well, I've got an idea to help the family that doesn't budget, plan, and save. What I'm going to do is I'm going to start a company. What they can do is send their paychecks to my company. I'm going to pay their bills for them. I'm going to set a little money aside in savings. And my parents kind of politely looked at me and they smiled and they said, Matt, I don't think anybody's going to turn over their finances to a 12-year-old. But I basically at that point said, well, okay, well then that's what I want to do. Over the years, we've been working really hard to put together a great team.
Michael Jordan said it best, that a strong player will win a game, but a team is who's going to win a championship.
What I've done is I've surrounded myself with a great support staff and a few additional financial advisors.
You know, I think everyone at Strategic Wealth Designers really takes pride in what they do.
And here at Strategic Wealth Designers,
We do really meaningful work and we truly believe that.
we have a championship team.
Clients are attracted to Strategic Wealth Designers because we do look out for their best interest. We are not a cookie cutter in any sense of the word.
Our history in Louisville, we've been around since 1997.
Clients are looking for guidance,
To get a second opinion.
from somebody that they really feel like that they can trust.
We've done the radio show, we've got a TV show.
And we're on every single week. Welcome to this week's show. But if we take a look at money over time, stock market rises where we look to take advantage of the upswings in the market, but not it really gives our viewers an opportunity to get to know myself and the firm and what it is that we do to try and help those that are looking for a way to have a successful, secure retirement.
Our biggest focus is to make it a stress-free, relaxing experience for a client.
You've worked your entire life, you've probably sacrificed, you had a family, you did things for your career, and now it's really your time.
Let us take the burden and allow you to enjoy your retirement.
We help those that are retired or soon to be retired transition their retirement nest egg into a system to where they can have guaranteed income for life so they never have to worry about running out of money.
At Strategic Wealth Designers, that's what we do.
You made it. Years of hard work, investing, planning, and now you're here. The long-awaited reward you spent a lifetime looking forward to. But what now? After years of growing a nest egg, now you may want to manage it. Use it to fund your dreams. Make it last as long as you need it. And leave some for those you love. So what do? Wall Street continues to be uncertain, and some conservative options have dropped through the floor. How do you maintain opportunities for growth and reduce risk of loss from market changes? That's where we come in. We are financial professionals. From investments and insurance products to tax reduction strategies and guaranteed retirement income you cannot outlive, provided by the claims-paying ability of insurance companies. You've worked a lifetime to get here. Let us help you enjoy it to the fullest. For an informational guide entitled 10 Things to Know About Retirement Income, simply contact us today.
On this segment of Strategic Wealth University, we're going to be talking about bull markets and bear markets, the difference between the two, how to spot them, and how a portfolio can be positioned during these different economic climates. So first off, what's a bull market? So a bull market is where a market is rising or is expected to rise. This in turn creates and promotes consumer buying, which continues to rise the price or the overall market index. Now, if we flip that on the other side, what's a bear market? So a bear market is where a market is falling or it's also expected to fall. Now, this in turn creates and promotes consumer selling, which continues to lower the price or the overall market index. Now, let's take a look at some past scenarios where bull markets have occurred. If we look back at 2000, we have the dot-com bubble. So after this followed a bear market. If we look back at 2007, 2008, we have the real estate bubble, and following we have a bear market. So if we look at 2014, 2015 area, we have a bull market caused by a variety of factors. Now, looking at the market climates, we can start to see a pattern emerge. We see a period of a bull market followed by a bear market. And what happens is yet to be determined for our current economic cycle, but if we look at past historical data, it's safe to say that another bear market is soon to follow. So something that we talk about is the likelihood of a market correction happening. Now, a correction on average happens every 7 to 8 years. In the 7th year, there's about an 80% chance that the market's going to go through a correction. And in the 8th year, that number jumps up to 90%. So we only have a 10% chance of generating a positive return in the 8th year. I don't know about you, but there seems to be so much more risk than there is really reward. Now, something that's very interesting is how these cycles, or bull and bear markets, travel, meaning how they move up or down. Now, a major misconception, especially for a bear market, is that it moves only down, meaning that the only direction over the term of the bear market is that only moves down. Now, what we see from past historical corrections or past bear markets is that there are and have always been wild upswings too. There could be a 15% downside correction followed by a 5% upside correction, followed again by a 10% downswing. Now, the most important thing to take away from this is that the 5% gain doesn't always indicate that the correction is over, and it is extremely difficult to time these brief or minor upswings. A lot of investors make the mistake of buying back into the market towards the peak of these minor upswings, and then as soon as the buyback or as soon as they buy back in, the price level or the investment continues to fall. In this instance, it is really important not to try and catch a falling knife. If you see that something's falling or it's probably heading that direction, it's best not to guess its floor or predict its bottom, because more times than not, based on statistics, we are not going to be able to consistently and accurately determine the floor of an investment. Now, bull markets are a bit more predictable, and while there are seemingly continuous upswings, there are some downticks as well. But the key thing to take away from bull markets and bear markets is the trend. I know we're about to have some graphics come up, so let me go ahead and explain these. In this first one, this is an upward moving bull market trend. Now, what do we see? We see an upswing, a small downswing, but the bottom point or the change of direction is never lower than the last uptick, meaning that each time there is an upward cycle, we're still higher than we were before. Now, let's go ahead and flip the graph. I want to take a look at a bear market. So we can see from this that there are continuous down and upswings. But what we can take away is that each time we have a brief upswing, it is never higher than the previous downward point. Now, investors will often see this trend and think the bear market's over. Then the behavior kicks in where they don't want to miss out on the gains, and then they buy back in right before things to head back down again. So again, if we look at some numbers, we can see that the average investor cannot effectively time the market. The best thing to do when we're riding the roller coaster, so to speak, is to first and foremost consider getting off the roller coaster to avoid further drops. And also one thing we really need to try to do is to maintain patience. Now what comes to mind? You think, all right, I have this information, but how do I position myself for a bull or a bear market? You know, how can I achieve safety, but at the same time see a reasonable rate of return? Now in bull markets, equities or stocks typically will have reasonable returns. During a bull market, to fully capitalize on the upswings, a portfolio will help maximize itself by having stocks or equities. Now on the flip side, what do we do when we have a bear market? First and foremost, we have to have a properly allocated portfolio, meaning that we need to have a large portion of our portfolio in investments where we never have to worry about losing anything. Something like this could be a CD. For something with some more potential upside growth, an annuity could also be an option. Now the portion of the portfolio that we have more upside potential for, that we've decided that this is the portion where we can have some risk or take some risk. We could have stop losses on those positions. Now this enables us to sell out of the portfolio or each holding at a certain predetermined price that we determine. So really understanding past historical bull and bear markets is vital for determining when to invest and really when to get out of the market. If you would like more information about how Strategic Wealth invests in and during these economic climates, please give our office a call or feel free to check us out on the web.
Remember when life was simpler? When things didn't move quite so fast and the world didn't seem so complex? Remember that? We do. And as the world around us has continued to speed up, becoming more complicated and still a bit uncertain, we have managed to keep things simple, providing sound, easy-to-understand financial advice and customized roadmaps for the road ahead, from tax reduction strategies, investment advice, and guaranteed retirement income you cannot outlive, backed by the claims-paying ability of insurance companies. We can be your single point of contact, a single call, a voice you recognize well, and a partner who can be by your side for the entire journey. We can't stop the world around us, but we can help ensure you're prepared for what's to come. To schedule a no-obligation meeting, simply contact us today.
You're on the back nine heading for the clubhouse. Your dreams of spending time with family and enjoying retirement are just within reach. What happens if you end up in the rough? In these uncertain times, it's crucial to be prepared with sound advice. Strategic Wealth Designers is one of Kentucky's premier retirement planning specialists. For a complimentary consultation, call 1-502-653-6080. Strategic Wealth Designers. Plan to retire well.